Frankenberg. I teach martial arts. I have been for just over 25 years now. I still own the martial arts studio. In fact, I'm broadcasting from my martial arts studio in Monument, Colorado. It's very near my home in sunny Palmer Lake, Colorado. And a number of years ago, I got pretty successful with the karate school business and had a bunch of extra money I started to want to put into investments, and started out putting that into real estate, and found out that I just didn't want to be a landlord.
Mm-hmm.
And so I went to one of these weekend seminars where you learn how to spread trade and do covered calls, and I ended up getting hurt, Mike. And the reason was that everything worked out pretty good for a while. I got overconfidence, and I also listened to some really poor instruction about risk. And I ended up exposing my account completely and getting hurt really badly. Well, Mike, one of the things that I always teach my mixed martial arts students, folks that go into the cage and fight for the belt and so forth,
Mm-hmm.
I teach them, keep your hands up. Focus on defense. Focus on not getting hurt, and then everything else will take care of itself. And I figured, well, geez, I do that with my students, but I didn't do that with my account. And that's what caused me to get hurt. Once I changed my approach, Mike, about 10 years ago, I started to win. I started to win consistently.
Mm-hmm.
And wrote a book about it. I actually was asked to write a book about it. And began distributing that back in April 2003. And the setup that I've been using all this time, we're going to show today. So, okay, Mike, let's hear a little bit about you and what you're about and where you're from.
All right. My name is Mike Chupka. I'm the Director of Education here at PowerOptions. PowerOptions is, of course, a patented suite of search and analysis tools designed for self-directed options investors. I've had the great pleasure of working here for about 8.5 years now. I got started in options investing and working with Ernie the same way that most investors probably did. Learned about covered calls and, of course, the natural conversion over to naked puts to see if the parity trade was just as good or could perform as well, because I wasn't happy with my results, of course. And after that, branched into standard collars and calendar spreads as well. I had some great success with those, but I also ended up giving a lot back to the market during a certain downturn. This was about 4 or 5 years ago. And even though I've been trading standard collars, I got introduced to Kurt about 3 years ago. He was actually a customer of PowerOptions and was using our backtesting tools, our historical suite of tools, to try to identify some past trades on his radioactive technique. And we walked through that, and when I first saw the setup, I said, Kurt, I understand that you're limiting risk. I see that you've got a low-risk position, single-digit risk amount. I can understand the benefits of that, but I don't know if I agree with this setup. You've got so much invested in it. It looks like you're going to need a 15, 20, 25% increase in the stock price in order to make any money on the position. And Kurt, of course, said, well, really, why don't you join me for one of my free webinars, just like we're doing right now, and Kurt was going to show me how he makes money with this position. Of course, I was so impressed with it, I invited Ernie Renner, the president and founder of PowerOptions, to join us for the next few presentations. And he was so impressed with it, we decided to partner up with Kurt, and Ernie's been making some enhancements and adding some ideas to Kurt's full work there, the blueprint, of course, where Kurt's full method and all 10 income methods that are used are described in detail. And we've enhanced the PowerOptions tools, of course, to work with Kurt's system as well.
Right. That last part of that sentence there, where you said we've enhanced some of the tools at PowerOptions. Basically, what you guys did was open it up to a total wish list for both me and for folks that have been trading radioactively for years, and come up with some really outstanding tools that are specifically for radioactive traders. So anyway, that was a real modest way for you to put it, but I'm really impressed. And at the end of today, we're going to give away some free free looks at that exactly that the radioactive trading tools on PowerOptions. So okay, Mike, enough about us. Let's go ahead and find out a little bit more about our viewers. Here's what to expect from today's presentation. You're going to learn the biggest problem facing traders today and the solution to that problem, and how a simple tweak can drastically improve your trading if you do it. Okay, and we're going to actually do a poll to find out where your trading is right now. We're going to show you a couple of things, and then ask, well, geez, if you knew this last year, would you have had a better year? So it won't be, it won't be my claims. It won't be Mike's fantastic success that he's been having with radioactive trading. It'll be your own input. Okay. All right. Here's another thing. We're going to learn 2 spread trades that will take money now, is what one of them does, and another one guarantees more in the future. But both of them are done with 0 risk. It's a spread trade done with 0 risk, and in fact, we've got more than more than one. We're only going to share 2 today. Okay. All right. Now, Mike, I'm going to do 2 polls. Okay. First of all, I'd like to know how everybody is involved with radioactive trading now, what kind of option strategies they're using now, and folks, we're going to just leave these polls up for like 30 seconds. We've got a lot to cover, short time to do it, and I really want to respect everybody's time and finish on time here today, about 15 minutes past the hour. If you've got to get out before then, don't worry about missing the presentation because we do have some recorded options. Okay?
And I am recording this one as well, and it'll be posted probably, if not later this afternoon, the first thing tomorrow morning. No, let's go tomorrow afternoon.
Very good. Okay, Mike, that's 30 seconds. Let me go ahead and close that poll and share the results. 72% are using the free materials. That's marvelous. I'd like to expose the other 28% to the free stuff. Okay, there's a lot of things under the tab marked resources on radioactivetrading.com that are free to you to use. Also, the YouTube videos, the instructional videos on PowerOptions, wonderful stuff, and a lot of it is, well, all of it is free. Okay, so that's the free materials. Okay, 44% are thinking about buying the blueprint. That's marvelous. I don't want you to buy it unless, of course, you think that we've given you some value today. And I'll tell you what, we are going to spend about 3% of the time on promotion. I am going to promote my book, but the other 97% of the time is going to be spent on education. You know, we're trying to give first, and if you decide that you really like what radioactive trading has to offer, maybe you want to pick up the blueprint, and especially with the money-back, risk-free guarantee. Okay, 17% already own the blueprint, and they're here to review the basics. So I'm very pleased to have you guys here. Okay, let's go ahead and find out very quickly what level of difficulty of options trading, or what kind of trading clearance you are using right now. What are you utilizing? Okay, not what are you cleared to do. You might be cleared to do naked calls, but you don't do it. Okay, maybe you're a total newbie, have never done options trading. Maybe like me and like Mike, you've been introduced to the world of options trading by way of the gateway drug, cover calls. Okay, and that's 30 seconds. Let me go ahead. Oh, folks are still rolling those in. Guys, I'm sorry. I've got to stop it. Okay, I've got to cut it off because we've got to, you know, we've got to respect everybody's time. Okay, so nobody said options amino like it. That's great. Our winner here today is long calls and puts, and second place is a tie between cover calls and spread trades. That's marvelous. A very high number of folks are doing naked calls, or yeah, they say they're doing naked calls, right, Mike? Didn't I say?
Yeah. What are we actually trading? Not qualified to do, because you and I are, you know, qualified to trade naked calls. We just don't prefer not to do it. Doesn't match our risk reward tolerance.
That's right. It doesn't match mine. And in this market, naked calls might be a bad scene. You know, we've been seeing things go up with, you know, pretty unprecedented power here recently. So, okay, Mike, let's talk. Are we back to my screen? Can you see my screen?
We are bulletproofing with the income method, sir.
Okay, good. I'm going to make a bold promise with one simple setup. I'm going to show you how to solve the biggest problem that most people have with their trading and solve it forever. And I'm willing to bet that you're going to take a look back and wish that you had done it sooner. We're going to find that out by way of the polls, okay? After showing that basic setup that can instantly improve your trading, we're going to see if it would have made a measurable difference, all right? And then here's another promise. After that setup, we're going to share the 2 of the income methods, okay? And both of which leave the upside open. A lot of folks don't realize that you know, selling covered calls, of course, is the I call it the gateway drug, but it's the most well-known way of taking income from a stock that you own without necessarily selling the stock. Well, there's a lot of other ways to do it, isn't there, Mike?
That's right, yeah.
Yeah, yeah. And selling a covered call, if you sell a covered call, you do not leave your upside open if the stock decides to keep going. But both of these that I'm going to show today, we've got, I think, 5 out of the 10 income methods. I think 5 of them still leave the upside open. But we're going to share a number of them today. We're going to share 2. Okay? All right, so these are only 2 out of the 10 income method adjustments. We're going to show the money net, okay, and the ATM machine. And if you do covered calls, you're never going to want to do it the old way again. And if you do spread trades, gosh, what would it be like to do a spread trade and not be biting your fingernails up to the second knuckle, knowing that that you're not introducing any risk to your position? Okay. All right. So, Mike, the 2 biggest problems. Have you ever heard this saying? And I'm sure that folks online, you've also heard this. It begins like this: cut your losers short, and what's the rest of it?
Well, I know the answer, but I'm not going to say.
Oh, you're not going to say. I wonder if one of our folks on the line, you could just text that into me, okay? Cut your losers short. What's the rest? Dave says, thanks so much, Mike. Oh, he's answering your question. Okay. I'm sorry. I just tuned in there. Let your winners run, let your winners run, let your winners run. We got a lot of folks texting in the answer, okay? And that's correct. Cut your losers short, let your winners run. That is one of those sayings that, oh, it seems trite. You know, it seems like, oh, sure, you know, kind of like buy low, sell high. I'll just do that, Kurt. Thanks a lot. But you know, honestly, it actually is possible to set up your trades so that you always do this. Okay, we don't always do this, Mike, if we don't structure things that way.
That's right.
The market is rampant chaos. What order does it have?
It has no order into the market.
It has no.
We can bring order to the market, but when we start off, there is no order to the market.
That's right. I like what you said. You can bring order to the market. What if you could set up your trades so that you would always do this, so that you would cut your losers short when you picked a bad one, right? And that you let your winners run without limiting yourself when they did turn out to be a good pick? Well, what if you could? Now, Mike, I'm showing the graph right here of an issue that I traded during the time frame that I'm showing. And does it look like there's some opportunities to win here?
Absolutely. I see lots of opportunities, whether you're bullish or bearish on the position. There's not a lot of neutral place. Well, I guess there's a couple, but really, I mean, unless when you have a wide spread, there's not a lot of neutral activity going on here, of course. But yeah, there are plenty of positions where you can buy near the bottom and maybe sell up near some of the highs there, near the double top, or you could have shorted near that double top and closed out the position in that valley and then maybe bought back in at the bottom of that valley and then let the stock go back up. But you also could have shorted down at the valley, or thinking there was a time when it had peaked up after it had been at the bottom. You thought it was going to drop again, shorted there, and then watched it run up and gotten into a lot of trouble. Or vice versa, we could have bought near the double top thinking it was going to go higher and then had probably gotten stopped out in the next 30 or 40 days as well.
Right. There's really no guarantee, and the problem here is the fact that I just don't know what's going to happen next. And because I don't know what's going to happen next, hope and fear rule my trading if I don't set it up correctly. If I just buy the stock, or if I just short the stock, all right, and maybe I've got some exit rules, okay. But man, can you see some gaps here that I would get hurt with a stop order?
A lot of potential to get hurt with a stop order there, where you wouldn't get out at the listed price. You wouldn't get closed out at your stop order. You get closed out at a much less desirable price, for lack of a better term.
That's right. Well, Mike, anybody that's traded with stop orders doesn't need a lecture. They know some of the problems with it. They know, first of all, it can betray you one way, and that's if you're setting a stop that's supposed to limit your loss, and then that stop gets violated, but then the stock goes back up. It just goes back up without you, right? Okay. On the other hand, if a really precipitous move happens, if something really big happens, blam, you could be out of your position at the worst possible price, okay, and it wouldn't actually protect you at the level that you thought. You know, it becomes a market order. me give you an example. If I buy in at $100 a share and I set a 10% stop, and the stock opens the next day at $50 a share, which that can happen, can't it?
Mm-hmm.
Okay. Okay. Do I get out at my $90? Do I get out of my 10% stock?
No.
I'm sorry. Stop.
Unfortunately, no. You're going to have
Yeah.
your stop loss is going to get violated. You're going to get closed at the opening price of $50, so you now have close to a 50% loss in your position.
Right. Okay, and we've seen that happen. Well,
Mm-hmm.
Mike, I'm going to go ahead and mention that I did trade this stock that's on the screen right now during the time period that it's tracking, but at no point could I have lost more than 5% of the capital that was in that trade, and plus 3 weeks in, I made it bulletproof. I made it so that I couldn't possibly lose. So I was sleeping really good nights. And then when it did have a run up, I made 10.22%. So thing is, never could have lost more than 5%. I was bulletproof for most of the time and ended up making over 10%. So if you lose nickels and you make dimes, man, I'd like to flip a coin all day long if I lose nickels when I'm wrong and make dimes when I'm right. Okay, so that's the idea. Okay, Mike, let's go ahead and take that baseline poll that we said that we would do, okay, and ask folks exactly how happy they are with their trading results. There's just not a yes or no here. There's a range of answers, okay? So if you meet or beat your expectations last year, you ought to be happy. All right, if you lost money, I guess that's just cause to be unhappy. If you had gains but maybe not enough gains, you might have mixed emotions. We've got a range here, range from extremely happy to extremely unhappy. And I predict, Mike, that most of our listeners are going to end up kind of in the middle there, and not so much at the extremes. I could be wrong on that, but that's kind of what it usually pans out as. Okay, now remember, folks, we're only going to leave these polls up 30 seconds so that we can move through this presentation today. So that's 30 seconds. I'm going to close it. Ready, set. If you didn't vote, do it now. Close. All right. Well, I was right. We had 4% in the I'm ecstatic zone, right? And at the other end of the spectrum, I'm ready to quit. We had 12%, okay? So that's really the minority, okay? Folks on either end of the total spectrum there. 24% are happy but can stand to be happier. 32%, about a third of everybody on the line, mixed emotions. I'm not exactly what you would call happy. My winners were taken down by my losers too much. And 28% said not happy. Overall losses, even with the bull market going on here, they've had overall losses. And anyway, Mike, this is our baseline reading. I'm going to introduce some ideas, and then we're going to run this poll again in light of those ideas and see if it would have improved everybody's trading. Okay? All right. Just before we discuss what the solution is for me, I'm going to ask, why has the problem not been solved yet? Okay? Most folks that have not done very well, let's show that poll up here again. Mike, we've got 4% plus 24%. We've got 28% that are overall happy, right?
Yes.
Which leaves 72% that are unsatisfied with their trading. And of course, many of the folks that said that they were happy with their trading, they said that they could stand to be happier, right? Okay. So why has the problem not been solved? Well, a lot of reasons. A lot of folks are unhappy with their particular trading results, but few know exactly where to start about improving it. Okay. And I'm going to ask folks on the line, what single thing do you think you need? If I could wave a magic wand and you could pick only one from this list of 5 things, okay, what do you think it would be for you? And this applies to everyone, whether you were happy with your trading results, whether you had mixed emotions, whether you're ready to quit, okay? Listen, if I could wave a magic wand and solve the biggest problem that you have in your trading, which of these 5 things do you think should be it? Okay? I'm leaving that poll up for another 3 seconds because it's 30 seconds. Okay, stop. Whoops. And share. Okay. And look, nobody wants to spend more time. Look at that, Mike, with their stock selection. 6% do wish that they could spend more time trading. All right. I don't happen to want to spend more time trading, and to be frank, I can't wave a magic wand and give you more time in your day, so I don't know how to do that. But for the other 94%, I think that I may have a solution. The folks, the 24% that said I need a more reliable system for timing, actually I shouldn't claim that I can help you, because the fact is I'm lousy at timing. I'm no good. You know this, Mike. I'm no good at timing, but that's okay. And the reason that it's okay is because I have solved the #1 biggest problem with Mike trading. And Mike, what is it for more than half of our participants today?
Well, we want to limit our losses, don't we?
Right. If you just limit your losses more, man, if you just limit your losses when you're wrong, okay, that would do the trick. Because, geez, you know, Mike, if a stock is going to lose 50% on me, but I've somehow made it so that I only lose 5, well, then I had bad timing and I picked a bad stock, right? But I've got 95 of my marbles to take and go play in another game. You know, eventually I'm going to find something. And then 18% said, man, if I can only make my wins bigger. Now, Mike, some of the income methods actually capture enough movement so that not only does the stock move up, but you pick up extra bank. I call it the money net. You've seen me apply the money nets a number of times. Would you say that we can actually help folks make their wins bigger?
Well, yeah. I mean, it outperforms plain vanilla covered call trading. It outperforms some of the other income methods as well, because you can leave your upside open and you're generating premium up front.
That's right. Okay, there's ways to generate premium. We'll get into that later, okay, about making our wins bigger. But for right now, I'm just going to say, hey, look, I've got a solution for what most of you realize the problem is. The problem is not having enough capital to trade because, man, you keep losing what you have in the bad trades. Okay, so the idea is cut your losers short, let your winners run. I'm going to ask you a question, Mike. Does the strategy of selling covered calls or selling naked puts go well with that idea?
Well, it's counter of that idea. It's the exact opposite. Well, if I sell a covered call or if I sell a naked put, for example, I've capped my upside, but I'm still taking on 95, 96, 97% of the risk of owning the stock. So I have the potential to let my losers run, and I've capped my gains on the upside.
Okay, so the reverse of that is not a good idea. I think that we're getting an idea of why some folks answered, I had overall losses last year, even with the bull market. And I think it's because of limiting the run up. You know, when you pick a winner, you limit the run up. And then when you don't have a winner, it kind of hurts, right? How about vertical spreads and butterflies and condors and stuff like that? Okay, how about nice spread trades? Do they let winners run, Mike?
No, they have a capped gain as well. They have a maximum profit based on the difference in the strike prices and the premium that's received.
Right. I'm going to show a couple of familiar graphs, okay, the covered call. Now, we're looking at this, and we recognize that it's a bullish trade because ownership of stock is the big part of it, all right? Ownership of stock, it is a bullish trade. I don't know if I really agree with this idea that the risk is safer because in order to get the really sexy premiums, Mike, what kind of stocks do you need to trade?
Well, those really big premiums that people want to see, the 5%, 6%, hey, we've seen 10, I've seen 15% return with an at-the-money covered call trade, believe it or not. And those types of stocks are going to be extremely volatile, and it adds to the risk. Sure, the stock could go up and you could get assigned and earn that return, but it could also drop 30 or 40%. It's volatile because it has an event coming up or something is wrong with the stock, earnings date, patent lawsuit, FDA approval for something. You're familiar with that, Kurtz, as well. So
Yeah.
that's some of the things that can happen, absolutely.
Mike's twisting the knife a little bit. I lost my shorts on an FDA approval or non-approval actually about 10 years ago, and that's how I came to develop radioactive trading is because I didn't want to be hurt by those kinds of events anymore. Okay. Well, anyway, looking at this, we are not cutting our losers short and letting our winners run. We're doing the reverse. Okay.
Right.
What about a spread trade? We certainly are cutting our losers short. Okay. If the stock moves in a certain direction that doesn't make sense for the play, but we also cap our gains too, right?
Mm-hmm.
Right down here it says that the reward is limited. Let me go back a space. Here's the cover call again. Reward is limited. Okay, but let's take a look at the married put position. Now, Mike, that's another bullish position. I'll certainly go along with the idea that it's safer, but what curious thing do we see over here on the reward side?
Well, it's unlimited, isn't it? There's nothing capping our gains. We still have unlimited upside profit potential at the initial setup.
That's right. And we do want to emphasize the word potential. It's not a guaranteed thing. But then again, Mike, how many times have you seen somebody buy a stock, sell a call against, and then see the stock go for the moon, and and they feel kind of like a chump because, oh, geez, you know, I gave somebody else the right to buy my stock at a bargain basement price and didn't take care of that run up myself. This is the other way to do it. Okay, it's cutting your losers short and letting your winners run. I think that makes sense to a lot of folks. Okay. All right. So, Mike, we've already discussed what the problem is. We've discussed why it hasn't been solved yet. It's because folks have not been taught how to set up their trades so that they have unlimited upside and limited risk. Okay. What is possible? What can we do? Let's take a look at this here, Mike. Just before I show the setup that limits your risk down to 6% or less, okay, let's just ask folks, looking back over the last 12 months, if you had kept your wins, but your losses were cut from whatever they were to 6% or less, would you be happier with your trading results? Okay, would you be happier? Now, if you answer that first one, I still would have lost money overall. You have to be real honest and say, man, I never took a loss as big as 6%. And 6% is something else. I never took a loss that big. Okay. I would have lost, but lost much less. Okay, that's how a lot of folks are answering. That'd make a difference between a losing year and a winning year, or how some folks are answering. That would put me over from unhappy to happy. You know, some folks had mixed emotions, right? They said, oh, geez, you know, I had a winning year, but it wasn't winning enough. You know, but would you be happier with your trading? Maybe. Okay. Or were you already happy with your trading results and you recognize that, man, that would have been even better. Okay? All right, Mike, I've actually had that up more than 30 seconds. Let me go ahead and close that poll and share the results. Wow. We had nobody say that it wouldn't have helped. Nobody.
Okay.
Went in that first category saying I would have still lost money overall. 11% say they would have lost but lost much less. Okay, 26%, that would have made the difference between the losing year and a year where they actually had a return. They made money. 42% would put you over from unhappy to happy, and 21% already had said that they were happy with their trading results. These are the folks that were in that first category. We had 4% say great year and 24% say I was happy but I could stand to be happier. Well, look, 21%. There they are. I was happy with my trading results, but I would be happier. How about that? Okay. Mike, I'm going to go ahead and show that setup here. But just before I do, I just want to put a dollar amount on that. Okay? I want to ask for a dollar amount and just estimate, you know, or guesstimate. Okay? Can you put a dollar amount on how much of a difference it would have made to you if you had limited your risk in all of your trades down to 6% or less, but you were able to keep your wins? So far, nobody has said, I don't get it. Nobody has said, I can't see how that would even help. And nobody has said the 350 either. All of the answers are concentrated in the top three. Oh, we finally had some folks say that they would have saved 350. Okay, let me go ahead and close that. That's 30 seconds. And share the results. Nobody said they didn't get it. 5% would have saved 350. 30% ahead by 1,000 to 5,000. 35, 5,000 to 10,000. And 30%, this information would have made at least $10,000 difference. Mike, in Colorado Springs, about this time last year, I did this exact seminar. I did it live. And I went around the room because, you know, we didn't need to do the electronic poll. I went around the room. One fellow raised his hand and said, try $30,000. And I said, sir, you would have had $30,000 more at the end of the year if you'd have done this? He says, no, I would have had $30,000 more at the end of one of my bad trades.
Yeah. Too much risk in one position.
That's right. Okay, so if he had only done this setup, okay? All right, so Mike, let's go ahead and show how to actually do that, how to actually set ourselves up that way, okay? The structure of an RPM, the radioactive profit machine. Okay, here's an actual trade that I lost on, and I want to put this up there first so that folks can see that I actually brag about losers, okay? I lost on this one. Network appliance, got shares at $56.50. At the same time, a June 2011 $65 put option for $11. Okay. Well, Mike, this looks a little weird. I mean, this is January, and I'm buying a June put, and is it in the money or out of the money?
You're in the money. That's why it's so expensive. I mean, you're still paying, if you look at it up front, you're still paying, you know, close to about a fifth of the underlying price of the stock. You're adding a fifth of the cost into the position, so you have a total investment of $67.50 on a stock trading at 56.
That's right. But Mike, here's the deal. Okay, out of that total invested of $67.50 per share, okay, I do have a guaranteed exit. I'm guaranteed between January and June that I can get out at $65. Okay, because of this put option. So the difference is really all that I have at risk. What I have at risk is $2.50, okay, which when we divide that $2.50 by the $67.50, why then now we have 3.7% of my underlying capital is at risk, okay? Now, do I have an unlimited upside?
Yes, the put option didn't cap your gain. It's actually insuring the stock, but it's really its own security, but it is insuring the stock position. But we haven't done anything to cap the potential upside gain.
All right. Now, Mike, I've had people tell me that, well, Kurt, you know, you can't, in fact, you told me this. Kurt, you can't make a dime until the stock goes to $67.60. Right? I mean, if you're spending $67.50, you're not going to make anything until the stock gets to $67.60. Now, Mike, you know that by using the income methods, I'm able to lower that amount, lower the break even. And in fact, gosh, you've seen me where way before it gets to that price, I'm actually able to bulletproof or even guarantee a return, but still leave the upside open.
Right,
Okay.
and the hardest thing for new investors to see when they look at this technique, they're so used to covered calls trading where, okay, if the stock's trading above my strike price in the next 30 days, that's the maximum profit I can make, this 3%, 4%, or 5%. That's the highest I can make. Well, in this position, yes, your investment is $67.50, but you're not down 3.7% or $2.50 when you open the position. When you first open this position, you paid $11 for the put, but you could have turned around and sold it for probably $10.90, $10.95, just the difference between the bid and the ask price. So we're not driving the new car off the lot. We're not starting with a 20% decrease. We're not down 20%. When you open this position right away, you could probably liquidate it for only a 0.1 or a 0.05% potential loss. And if the stock moves up 20 or 30 cents, you might be able to close it for a 0.1 or a 0.2% gain right away if you wanted to. That's not the goal, but if you wanted to.
Right. Now, what actually happened, Mike, was Intap went down. It didn't look to me like it was very promising, and I got out. But I didn't get out with a 3.7% loss.
Right.
I got out with a 1.2% loss.
And how far down was the stock?
Oh, it was 11%.
Actually, I think we have it at 12.4% by the time you closed it. Yeah.
Oh, okay. Well, anyway, the point is, while some folks lost 12%, I lost 1.2. I'm able to take my 98.8 marbles and take them someplace else and put them in a different game, and that's really what the power is of radioactive trading. That's why I brag about my losers here, Mike, because it's really the losers, how I handle the losers, that makes it so that I have enough capital to put into the winners. So that's really the secret to trading. Okay, when you put together a married put position, okay, where you buy stock and also put option, all right, if the stock goes down, it can't go down by too much to really hurt you. On the other hand, it could certainly go up. Now this dashed line between the break even and the lowest possible amount that I can get out at, okay, we're going to work with this. In the former slide, in the slide just before, I showed where that difference here, that distance, is represented by 3.7%. Okay? All right. Well, Mike, I'm able to actually do some things about that. I didn't have a 3.7% loss, did I?
No.
No. And here's why. There's 3 factors that would make it so that I would lose that whole amount. The first factor is the stock going down. Well, do I have any control over that?
No, and in fact, that actually did happen with your NTAP position.
Right. I don't have any control over it. I have no idea what's going to happen. But the following 2 things I do have control over. Number 1, Mike, can I make adjustments to that position?
Yes, there are 10 different income methods you discuss in the blueprint where we can lower that risk by either generating income or even paying a debit in one scenario to guarantee us a higher payout.
Right. Now, in the other the other factor that that I do control, do I have to hold that put all the way out? Do I have to hold this position all the way out till June?
No.
It's a June put.
No, you can close it at any time. It's your choice. You didn't obligate yourself by selling a security, by selling an option. You bought an option, so you have the right to decide, hey, maybe I want to get out today, maybe I don't.
That's right. So, Mike, those 2 things that I am in control of, I am in control of whether or not to make adjustments, and I am in control of whether or not to hold that stock all the way out till the put expires. Because I am in control of those things, I was able to take my 3.7% possible loss and turn it into an actual 1.2% loss. So essentially, even though the stock was down by over 10%, you know, I didn't get hurt, and that's kind of cool. That's what I've just shown you, folks, ladies and gents. If you didn't get it, I've just shown you how to stay out of trouble. I've shown you how to keep your hands up. You know, if you're going to go into a cage match, you know, I teach martial arts. Not everybody that's on the line right now knows that because you joined me midstream. But I teach martial arts. That's what my occupation has been for the last 25 years. When I tell those guys to go into the ring, you know what I teach them? I teach them conditioning, and I teach them defense. The offense almost takes care of itself if you just keep yourself from getting tired out or getting hurt. Okay? And that's how it works in the market too. Now, real quick, Mike, we've already shown the setup. We've already seen what kind of impact that will make on people's trading. Okay, but let's just take it a step further. Okay, let's compare owning 3 positions. Number 1, straight stock. Number 2, a covered call position, which is straight stock plus the addition of a short call play, right? Or a married put, which is also straight stock plus the addition of a long put option. Okay? All right. Now, Mike, if the stock goes up 20%, that's going to make a difference to the person that owns the stock, right?
Yeah, they're going to have a 20% gain straight away.
Okay. What about the covered caller?
Well, they're going to have a, no, they're not going to make 20%. They're going to have a gain, but without adding more money into the position, they might let the position get assigned, take the 5% return.
Okay. And a person with a married put, they're going to make less, aren't they?
Well, they're going to make less than the stock, but they're probably going to make more than the covered calls trading because, yes, we paid a little bit extra for the insurance policy on the other side, so we didn't make the full 20%, but we're still going to outpace the gain of a standard covered call in this scenario.
Right. Case in point is my CMI position right now, where I bought CMI at you know, somewhere between 100 and 110, and then also an 110 put option. Now today it's at 117. But folks that bought it at 105 and sold the 110 call, guess what? they don't get to participate in the upside. I do. All right. So here's the deal. All right. The married put does yield less than the straight stock position, but it certainly yields more than the covered call trade. Okay. Now here's the deal. Let's take all of our winnings because all 3 position won, right?
That's right.
Take our winnings, yeah, and put it into a new play. Now in this play, the stock goes down by 20%. So does that impact the guys that own stock?
Oh yeah, they're technically going to lose 20% of that new position.
That's right. Okay, it impacts them the worst. What about the guys with the covered call? They took some premium in at the beginning.
Yeah, they've hedged their loss a little bit, but they still are going to have a loss on the downside. So they maybe lost 15%, assuming they're still able to generate 5% of premium.
Okay, but what about the married put when it's set up in such a way that it can only risk 5, 6, 7%?
Well, we're going to have a limited loss, aren't we? We placed the put in on purpose to ensure our stock positions, and it worked for us. With a 20% gap, we have a loss of maybe 5%.
Okay, now here's why the married put play is the way that I like to start everything, and we're going to show 2 riskless spread trades here in just a moment. But the way that I start everything is with stock and a put. Okay, when I'm bullish. Okay, if I'm bearish, I might do something different. But when I'm bullish, like I am now, I'm going to get in with stock and a put option. Now, Mike, if I just had straight stock, I made 20% on the stock, and I lose 20% on the next play, where am I? Pretty much the same?
Well, isn't that what mathematics tells us, that we'd be right at 0?
Yeah, but that's not how it works, really. It's a net loss. Let's put it another way. If I had $100 and I made 20% on my money, then I'd have $120, right?
Right.
Okay, but then if I lose 20% of my money, okay, if I lose 20% of 120, that's $24. I'm going to end up behind the curve. Okay, so making and then losing the same percent does not fly. Okay, I'd have to make more on the way up to counteract the fall on the way down. Okay, now the covered call, this kind of exacerbates the position because guess what? As the stock goes up, we are cutting our winner short and letting our loser run. Okay, so maybe we make less on the way up, but we also lose less on the way down. But guess what? It still ends up being a net loss and kind of a worse net loss. Okay, what about that married put position where we made less on the way up, but we lost a lot less on the way down? Well, that's a net winner. Okay, and let me explain something. Okay, this is the same market. I mean, this was a market that went up and then went down, all right? And we had different end results. The stock-only strategy has a net loss. The cover call strategy has a net loss. This explains why a lot of folks were unhappy with their trading last year, even with a bull market.
And more winners than losers, probably.
Yeah, exactly. You can actually have more winners and losers and lose money overall. But I've demonstrated that you can actually, and with real money, over years of time, trading my record publicly, I have demonstrated that you can be wrong more often than you're right. Because my timing stinks. I'm right only 47% of the time. But guess what? I'm an overall winner. I'm an overall winner because I win more on the way up and lose less on the way down. Okay? So the married put strategy here has a net gain of 9.25%. Out of the 3 strategies, the only one that did it was the one that, of its structure, of itself, cut the losers short and let the winners run. Got it? Okay. So what's different now? We've already run those polls. Mike, does this saying fit now? If we trade this way?
Well, yeah, we're forced into letting our cutting our losers short and letting our winners run, aren't we?
Right. We made ourselves do it. Okay. Yeah, when I ran this poll here, okay, we saw that 100% would have done better. 100% of our folks that are on the line. That's pretty much everybody, right? 100%.
That's right.
Okay, would have done better with their trading if they had only followed this kind of a plan, right? And remember, I said at the beginning, I'm willing to bet that everybody's going to wish that they had begun sooner, okay? And when we said, can you put a dollar amount on it, 5% would have saved exactly what the blueprint costs, okay? The blueprint is my book, costs $339 and $11 shipping, okay, so $350. So I paid for your blueprint, okay? I did. If if you put this stuff to work that we showed you for free today, and put it to work over the next year, okay, for 5% of you, I've paid for it. And for the other 95%, I paid even more, right?
Mm-hmm.
Between 1,000 and 5,000 says 30%. Between 5,000 and 10,000 says 35% of you. And 30% of you, 3 out of 10, said this information would have made at least a $10,000 difference. It's pretty cool. Okay. But that's not the best part. What else is different now? Mike, one of the best things about trading radioactively is that if you start in a place where you can't possibly lose more than just a small amount,
Mm-hmm.
then when the stock begins to behave a certain way, you're able to take advantage of that movement without necessarily selling it. Okay, it's kind of cool. Okay, let's take a look at this. Here's an actual trade I'm demonstrating right now with Humana Resources, where the entry price was $63.90 and the August $65 put was $5.80. Well, that's a total invested amount of $69.70. Guaranteed exit of $65, okay? So the amount at risk is $4.70 or 6.7% of the underlying position. Now, Mike, am I likely to lose that whole 6.7%?
No, again, from what we saw, you'd lose that if 3 conditions typically were met. If the stock declined in price, you held it all the way to August expiration, and you made no adjustments. Even if the stock dropped down to maybe $40 per share, $45 per share, had a sudden gap down tomorrow, you still probably wouldn't realize that full 6.7% loss.
Yeah, let me check my watch. Okay, not August yet. So, if Humana crashes right now, okay, if it crashes completely, I'm going to probably be able to sell the stock and the put separately for more than $65, right? And so my loss would be less than 6.7%. It'd probably be 6% or less than that. Okay, but that's where we start. Okay, now, Mike, that's the beginning position, and this is scalable. Okay, you do this with 100 shares and risk 470 each, or you could do it with 200 shares, buy 200 shares and buy 2 put options, and then it would still be 470 per share at risk. Okay, it's still 6.7% at risk, no matter how many hundreds of shares you get into. Okay, if you got into 10,000 shares, well, you'd buy 100 puts. Okay, and that would keep you at the 6.7% at risk ratio. Okay, here's the graph. Now, I want to draw your attention, Mike. Can you see that number right there? I don't know if everybody can. Can you see the maximum risk number?
Yes, it's 940. You're doing this with a 200 share example.
Right, okay, and clear out to August. All right, and then the maximum risk is 6.7%. The maximum profit is infinite, right?
That's right.
All right, if that stock decides to go up, it's going to go up. Now, here's the deal. If I'm trading a $100,000 account, I can take about 14 of it, say 13,940. I can put about 14 of it into Humana, but that would risk less than 1% of my entire portfolio, wouldn't it?
Right, that's exactly right. Per portfolio, these positions, you're keeping them down at about 1%, maybe 1.5% of your total portfolio value.
Right. Okay. Now, we've just seen the married put graph using the PowerOptions tools. Now, let's take a look at the graph of the bear call spread. Okay, a bear call spread, let's say, Mike, I was to sell the 6750s and buy the 70s. Okay? Now that's going to result in a credit, isn't it?
Yes, you're going to receive more premium on the 67.5 call than it's going to cost you to buy the 70 call.
Okay, if I sell 2 6750s and buy 2 70s, it's going to be a credit of 50 cents per spread or $100. If you look up here, the total cost is negative $100. I get paid $100 to do this. On the other hand, if the stock goes higher than 70, well, geez, if that's the case, I'm going to end up having to pay back my
the difference in the strike prices, yeah.
Right. So the difference in the strike prices is $2.50 times 2 contracts is going to be $500. All right, so my total risk here is $400, right?
That's right.
Okay, and my maximum profit I've already taken. I've taken my $100 in the front end. Okay, now, why is this good? It's not, all right, because it could close against me. But what if I combine them, okay? If I have the married put trade with 940 at risk, and then I put another 400 at risk by doing the income method 6 trade, how much does that add up to?
Well, just looking at that, that'd be about 1340 total at risk on the position, wouldn't it, Kurt?
That's what most folks believe, but the thing is, in order for this one to close against me, this one has to win. Let me say that again. For this to hurt me in any way whatsoever, this one has to win, and it has to win by more. Let's take a look at the graph, okay? When we combine these two trades, all right, if the bear call spread ends up costing me the maximum $400, okay, the stock has to go up enough to cancel that risk. See this? Dink, dink. Right there is the 67.50 and the 70. This is my bear call spread. Now, Mike, if the worst possible thing happens here, I'm going to still win if the stock goes up. And you know, if it keeps going up, guess what? Have I capped my upside like with the covered call?
No, and the reason why you haven't is because you now own long stock and a long call as part of the spread. So you have those two bullish instruments, and you have only one short call that's capping the gain. Well, in this case, it was two short calls that are capping the potential gain, but that's countered. The possibility of getting called out at 67.5 and capping the gain for those two short calls is countered by the long call you have in place that essentially you were paid to own.
Right. Now, if you'll notice here, when it said 940, it used to say 940 max risk. That was for the married put. Now it says 840 max risk. Why? Because I took in $100, and I never have to pay it back unless the stock goes up enough for me to, well, win. It's kind of cool. My risk has gone down too. Remember how it was 6.7% risk to get into the position? Now it's only 6.1% because of that credit that I've received. Now, Mike, this was April, okay? April expiration's already come and gone, and now I'm in a different position, right? If it had closed below 70, okay, or if it had closed below 67.50, I would keep my $100.
Yes.
Right? And
both options would have expired worthless.
Yeah, I'd still be able to do it again, wouldn't I?
That's right.
Okay. But let's take a look at a different one, okay? Let's take a look at a different one. You can do this repetitively, okay? You can take out all the risk. You can bulletproof your stock by taking in as much income as it takes to pay for your put. It's kind of cool, all right? When the and this is about half of my positions right now are in this status where the net cost for the stock and the put is less than the strike price of the put.
Right.
What that means is the stock still has unlimited upside potential, but it can't get hurt. Kind of cool. Okay. All right. Now let's take a look at that. Let's take a look at bulletproofing. Income method number 4 is one of the methods that I will use that doesn't necessarily take a credit. Okay. Or actually, it never takes a credit.
It never takes a credit. Yeah.
Right. Now. Can I do another trade? Okay, actually, this is outdated here, Mike. Expiration has happened. Okay, but can I do another trade to take out even more risk? Absolutely. Watch this. Remember how we paid for the put option?
Yeah, it was 580, 570.
Yeah. Okay. Well, what if I could use that put option to bring in more if the stock behaves a certain way? You see, when the stock goes up, the put goes down. Now, I had, what, 580, right?
I believe so, yeah.
Okay, by selling to close that put option, well, golly, it's come down in value. The reason it's come down in value is that the stock has gone up. But here's a news flash. You know what else has come down in value? Every other put. Okay, so I can buy to open an August $70 put for much less than I could have months ago. All right, what this means is I'm able to swap these guys. And it's going to cost me. It's going to cost me $2.80. But let's not forget something. If it costs me $2.80, what do I get in return?
Well, you get a higher guaranteed exit. Now you have a guaranteed exit of $70 instead of 65 through August expiration. So it's 5 points higher than where you started. So you paid 280 to give yourself 5-point higher guaranteed exit.
Right. It's suspiciously like spending $280 to get $5.
Mm-hmm.
That's kind of cool. Okay. Now here it is. You could do this repetitively, right? Oh, this is me doing it with CTSA. It's just me doing it with a different position, Mike, where I had bought the stock, also bought a put, sold the put, and bought another. Okay. And you end up being bulletproof. Here it is with Humana. Look at here. I've still got a 3.4% risk. Remember I started with 6.7?
Mm-hmm.
Now I've cut it in half. I've cut it exactly in half, okay, from here to there, all right? That much risk down to this much risk, okay? And if we combine that, I know I didn't add the bear call spread into that example, but if we combine that, okay, let's take a look. Here I am selling the 67.50s for 95 cents, buying the 70s for 45 cents, jittering the 50-cent credit.
That's the bear spread, yeah.
Is $100 in. Okay, now I've taken my risk down to 2.8, and looky again. But doing even if the stock closes exactly at $70,
mm-hmm.
I'm not getting hurt. I'm making money. And guess what? The stock is much above 70 now.
Yeah, and this is a little bit more of an advanced principle. You have a CD that you have available for purchase on radioactive trading of combining income methods where you're using two at the same time. You don't have to use two at the same time. This was just a good scenario to use it for on the Humana position where you combined income method number 6 that you saw first and income method number 4, which you typically call the ATM machine there. But they can also be used individually or in conjunction with other ones as well.
Yeah. Now, Mike, I'm going to say that particular trade that I showed, the income method number 4, the ATM machine,
mm-hmm.
I call it the ATM machine because you get money out, right? But you only get money out if you put it in.
Right. That's exactly right.
Does that make sense?
Mm-hmm.
Okay. Now, you did this with SLW, with Silver Wheaton.
Yeah, from July to December.
When you opened it in July, how much at risk did you have?
7% was the maximum risk on my Silver Wheaton position in July.
Okay, and then by August, did you bulletproof it by using an income method?
Yeah, the first income method I did, it was actually before August. It was about 3 weeks into the position. It was still in July when I sold the call, but I sold an August call, and that gave me the $1.50 or the 7% I initially had at risk as the stock was moving up.
Okay, so after that, you had a put option clear out to September or?
No, I was in December.
December?
Mm-hmm.
December, okay. And so with that put option clear out to December, then what happened as the stock went up, you repetitively did income method number 4,
I think I did it 5 times total.
Care to share with everybody what your end result was with a bulletproof stock that you continued to do income methods on?
Well, at one point, I knew that I had a guaranteed profit on the position. By November, I had a guaranteed profit on the position of 29.8%. Now, that wasn't my return at the time, but that just meant that now, if Silver Wheaton retraced and it dropped back in price, I was guaranteed a 30% win, or 29.8% win at one point. But when I finally liquidated the position in December, it was liquidated for a gain of about 59.8%.
Okay, 59.8%. A lot of folks didn't do that good last year, you know. But you not only did that well, you also had no worries at all because, you know, when you first started it in July, you had 7% at risk.
That's right.
And then by August, you have nothing at risk.
Mm-hmm.
And then after that, you had negative amounts at risk. You had guaranteed, even if the stock retraced, you had guaranteed 20% return, 30% return, and so on and so forth until you finally said, okay, I quit. And you took out a 59.8% gain. That's fabulous.
Mm-hmm.
Okay? So, Mike, rather than go on about your achievements or mine, I just want to ask folks, hey, look, do you think that you can do a little better with your trading if you start out with lower risk and then you introduce bulletproofing? You know, the income methods reduce this gap of what you could possibly lose, okay? And when you reduce that gap to less than 0, why then at that point there's nothing to lose. Okay, you still have the ability to move forward, but you can't move back. All right, and my saying is this: don't pick stocks, pick stops. And I don't mean a stop order. I mean a legal and binding contract that keeps you out of trouble, so that if the stock goes against you, you don't get hurt. You know what, guys? I don't know how long this bull market is going to last, but you know what else I don't do? Worry about it. I don't worry about it because, you know, the trend is your friend until the end when it bends. But when it bends, when it goes against me, I won't get hurt, okay? And neither should you. There's no reason that you should have to. Don't pick stocks, pick stops. And what I'd also like to say is don't time trades. Trade time. We only showed actually two of the least sexy. We showed two of the least sexy income methods because they're able to either take a credit or guarantee a higher return. But there's 10 different ways. There's 10 different arrows in the quiver.
And they're used for multiple markets. You know, some of the income methods work best if the stock has moved up. Some of the income methods can be applied if the stock doesn't move from when you first open the married put position, what Kurt calls the RPM, the radioactive profit machine. And there's even a few income methods that can be used when the stock declines in price, so it didn't go the way you want, but there's ways to make adjustments to lower your break even or lower your at risk, even if the stock is declining and you think it's going to come back up. That's all discussed in the blueprint.
Very cool. Mike, we're doing pretty good on time, and I would like to make some time for us to share some things, but I'd really like the audience to steer it. So first I'm going to do two final polls. This one I'm going to ask what'd you appreciate most about this webinar? Okay. And answer as many as you like. You don't have to be limited to any one answer. You can answer 2 or 3 or 5 things, you know, whatever turns you on, okay? And we'll do that, and then we're going to ask you guys where you want us to take it next, okay? All right, I've got to close this. I know some of you are still voting, but let me go ahead and close it, okay? And share the results. 50% were appreciative that it was free, all right? Good. I would think maybe 100% would appreciate that, but that's fine. Okay, 79% really like this idea of an income method that doesn't cap the upside. You know, you take in maybe a little bit less than with a covered call. When you do a bear call spread, right? You take in maybe a little less, but then again, you leave your upside open. Mike, I haven't even shown today, I haven't shown income method number 5, which could actually take in more than a covered call and still leave the upside open. So that's one of the super sexy ones. I'm going to encourage you to pick up the blueprint to learn about it. Okay, let's see. Second place was unlimited upside in case of a run up, and tie for third. If you limit your losses, the rest almost takes care of itself. And then bulletproofing, taking a trade from low risk to no risk. All right, let me do a final poll, and you can and we'll use those results to know what we need to do next. Okay. All right. What would you like to learn more about next? So I learn how to get the blueprint. Do you happen to already own the blueprints and you'd like to know how to get more out of it? Would you like to know about tools available to find and manage these kinds of trades? And would you like for me to tell you about Fission, the subscription where you get to look over my shoulder and the shoulders of other successful traders and see what we're doing, how we're responding real time to the market? Okay, and that's been up for 30 seconds. Let me go ahead and close her. Wow, that's pretty overwhelming, Mike. Tell me about tools available to find and manage these kinds of trades. Mike, I'm going to defer to you. I'm going to turn it over to you, sir, and ask you to show just the tip of the iceberg. I know that the PowerOptions tools can do so much, but let's look at the search and destroy option, is what I call it, and maybe you can explain how to find and manage these kinds of trades. Can do?
Yeah, I'm going to show one thing real quick first, of course, and that's because we don't have a lot of time. There's no way I can do really show the tools in a 5-10 minute period here.
No.
Let's see. Something just switched, and I apologize, ladies and gentlemen. I'm just looking for something here. Oh, you're showing the poll results. That's what's happening. Okay. All right.
Okay, I got to hide it. All right, I did hide it, and now you should be the presenter. And I'll go ahead and take over. I know that you've been
There we
answering
go.
some questions.
I apologize.
Yeah.
There we go. Now I'm better. Okay. So the first thing I wanted to show, if you don't already have a 14-day free trial to Power Options, and if you decide to buy the blueprint today, you will receive a full 30-day unlimited access to Power Options. But if right now you don't own the blueprint yet, you want to test the site, if you go to radioactivetrading.com, you go to Kurt's site, which I'll show a little bit later, in the Resources tab, radioactivetrading.com, you'll see where you can sign up for a free 2-week trial of the Power Options tools I'm going to show in just a minute. Now, while I'm here, very quickly, if you want to get really in-depth into the Power Options tools, you have some time to spend. If you go into that free webinars and podcast menu, you see some of Kurt's webinar archives and some of his recent radioactive trades. Down below, there's a full section on just using the Power Options tools for radioactive traders. So there's one just on the search tool that's about an hour long. Using the tools for research and analysis, that's about an hour long as well. And then the portfolio tools and open discussions as well. So you can review those in your time. Just go to radioactivetrading.com, free webinars and podcasts. You can review some of Kurt's presentations, which he shares other income methods. And then, of course, review the Power Options for radioactive trading presentations. Now, the Power Options tools themselves, if you sign up for that 14-day free trial by going to powerop.com/RAT or going to the Resources tab on radioactive trading, when you sign up for the 14-day free trial, this is what you'll see. And it's tab navigation system. We have several strategies here. You have your covered calls, naked puts, and we support over 23 different strategies. But we want to focus on the married put, and we see the information here, a few bullet points, descriptions of the various tools you can use, the insurance tool to lock in profit if you have a stock position that's increased in price, the portfolio tools, of course, the search by symbol tool if you already know the stock. But we want to focus on the search tool, the patented Smart Search Excel tool on Power Options. And what this tool does is in every strategy, but we're looking at the married puts, of course, it scanned across the entire universe of options and identified only those positions that matched a specific set of criteria. So what you see here in what we call the results table, which is showing the listed trades. Well, our first trade, we have eBay. And as Kurt mentioned on his blog at Radioactive Trading, you can see some of the recent trade he was in on eBay with different prices, of course. But as we saw with the 5-line setup we went through with Humana and everything that's in the beginning of the presentation, we have eBay at $32.94. We're shown we can buy an October 37 strike put for $5.45. So the total into the position would be $38.39. $32.94 plus $5.45 gives us a debit of $38.39, a total cost into the position. But we're guaranteed an exit of $37, so we're only risking $1.39. That's the most we could lose. Again, if and only if we held the stock all the way to October expiration, eBay was still trading below $37 per share, and we made no adjustments. It's the only time we'd lose that full $139 or that 3.6%. Now,
I should, Mike, I should interject just real quick. I want to make sure that everybody understands we're not making a recommendation here, but we are doing a demonstration. We're showing the power of the Power Options tools to help you do the math. I mean, the math is done for me there, all the heavy lifting, and to find stocks and option combinations that fit the criteria to keep your risk down to a certain amount. Okay?
Right.
So,
Now,
yeah, go ahead.
So you came in. Now, these aren't recommendations. You see I have a total of 95 results in the results table. But what was done here, and there's only a few columns that are listed, I can select to see over 30 different stock data columns and about 30 different option data columns in here as well in the results table, depending on my preference. But if we scroll down below the results table, we're going to go to the parameter field here. And as you see, we have selected the default radioactive search from the drop-down menu. Now, here are some other searches that I've created during different webinars showing the tools. The webinar that was archived there on radioactive trading, this is one for part 3. This is the search that we used when we were going through those webinars there. And it's not a recommendation either. It's just, let's say you wanted to make some changes. And this might be daunting at first, but don't let it be. Just focus on what you know. Some of these criteria that are here, days expiration 150 to 900, risk of 3.5 to 9%, and being less than 20% of the money, These are in here because they follow the 3 core principles of radioactive trading that are discussed in the blueprint and the Foundations of Radioactive Trading CD, which you receive for free when you purchase the blueprint. But the other criteria, you can tweak this based on your personal preference. My personal preference, you know, Kurt, is that I don't trade stocks that are above $50 just because of my personal account size. I may also want to trade stocks that pay a dividend. I could do that as well. I might want to look for a higher average stock volume, for example. Let's put in 750. That's measured in thousands. Okay, so let me just make some changes there. I want to see more volume in my positions. If I wanted to go for open interest or so forth, I could do that as well. And there's also various technical criteria if you wanted to screen by Bollinger Bands or RSI. And as you see, I want to point out at the bottom here, Kurt's preference is to use the IBD50 and CanSlim list as a starting point to identify his trades. But hey, you can customize that too. You could create no lists. You could create your own personal list or your own watch list. Or you could screen against ETFs, for example, if you just wanted to look for RPMs on ETFs. So you can customize this any way you want to, and it's looking at all possible 3,500 optionable stocks, 3,500 plus optionable stocks, and roughly over 170,000, I believe, potential put options. eBay's still at the top of my list, but you notice how I've just that small change, changing my stock price and looking for a higher average stock volume, I've narrowed this down to only 31 total results. This is a good, manageable list. And once I've identified this in the search, well, right next to the position we have these more information buttons, so I probably take a look at the stock chart, want to make sure it's going in a desired direction. We can evaluate that profit and loss chart that Kurt showed earlier, run our what-if scenarios, do further research in the company information, recent headlines, the profile. We can compare it to other positions on eBay. Maybe I don't want to go this deep in the money and take this risk. What if I bought further down here, let's say the October 34 put? Well, it's a 6.9% risk, but that's still within my range. It's just not as deep in the money. And the blueprint, the blueprint discusses why would I choose one over the other. If I have 4 eBay positions here, you can see those, can't you, Kurt? There's 4 different listings for eBay. Here's one. Here's our second one using the 36 put for October, the 35, it's just counting down numerically, and then the 34. Well, as I go further down in strike price, I'm increasing the risk. Why would I take a higher risk on the position? Isn't the goal to take the lowest risk? Well, not necessarily. All this is discussed in the blueprint. It's going to help you to evaluate which one is the best for your personal needs, your expectation, what Kurt refers to as the SIGA model. And very quickly, while we're here, that's just the tip of the search iceberg. There's a lot of functionality you can do in here. But what about afterwards, Kurt? What about after you identify a position? Okay, I decided I wanted to go with that eBay position or the CMI position you and I were talking about earlier. Well, we've got a full set of portfolio tools where you can track your positions. Yeah? So some of the things that Kurt showed you, you don't want to sit there with pencil and paper looking through an option chain and building these particular ones. We've got the CMI position. You actually bought it at 110.30, Kurt. I looked that up briefly. So you bought the stock at 110.30. It was an at-the-money position because you were trying to match the covered call. And you, at the same time, bought the September 110 put for 970. So that means your total investments on the position would have been about 120 even, it looks like. But now that the stock has moved up, there's some potential to do some of those adjustments. And if you're tracking it in the PowerOptions portfolio, I'll go to the position analysis screen for my CMI position, and this gives me a breakdown of your position. Well, there's your stock, and there's your put price, your static break even if you held it all the way to expiration and made no adjustments, your days remaining to expiration, of course. The total maximum risk on this was 8.3%. And you see, you could liquidate right now for about 2.1% after 19 days, and your total investment, of course, and your future expiration, if you held it all the way to, what is that? I'm sorry, guys. September expiration, and the stock was still at 116.32, it'd be a loss of 3.1%. Down below, now you have some listings with the math done for you for income method number 1, just telling the call against it. There's actually a bulletproof opportunity here using income method number 3 if you decided you wanted to shorten the time frame of the position. And some of the things we saw before, here are opportunities, Here are opportunities for income method number 4 to lower the risk by adjusting the put strike price, and a potential for a income method number 6 position. And it's great to see it numerically, but as you're evaluating this on the analysis page from the portfolio, I can simulate this trade. I can simulate applying income method number 6 to my existing RPM. And
this is powerful.
This gives me a side-by-side comparison. Now, let me do this first. On the left is the numerics of the original position. On the right is the numerics of the new position, the lowered risk from 8.3 to 7.7%, monetary risk down to 922, but still have that infinite maximum profit. Here's your original RPM curve on CMI. Here's what your RPM would look like at May expiration. Of course, the curved red line using the Black-Scholes pricing model. Now, why are we showing May expiration? Because if you use the income method number 6 with the May series, we want to compare the two side by side. And this blue line now shows us what your RPM would look like, Kurt, if you applied income method number 6. So we're evaluating here, okay, if I expect the stock to be trading up at 125 or maybe 130 in the next 35 days or so, 40 days, does this match my expectation? This is done for you graphically and numerically to help your decision-making process based on your expectation on a stock.
Wow, Mike, what I really like about that, can you go back a little bit? I like the Power Options tools in the first place for finding the trade, finding the stock and the put combination. But afterwards, after the stock is moved, when it gives you, I think it's 4 different ideas. It says, okay, you could do income method 1, you could do income method 3, number 4, or number 6, due to what has happened in the stock. And then here are the numbers for you. It's already crunched. Man, I love that. I love that. I love that I could take it down to a 1.2% risk by doing income method number 3 there, one of those income method 3s. Or I could take it down to 0 risk.
That's right.
You know, that's amazing. So, Mike, that's fabulous. I tell you what, folks. I was a customer of Power Options before I became partnered up with them. And it's a loose partnership. I mean, what I do is I say, hey, guys, this is the best stuff in the world. and folks that have read my book say, not only is it the best stuff in the world, this is the best for trading radioactively because it's the only platform that supports all 10 of the radioactive trading income methods. So, all right. Mike, can I take the screen back from you?
Go ahead, sir, yeah. I wanted to talk a little bit too, so I wanted to show everyone. And just remember, folks, on radioactivetrading.com, in that free webinars and podcast link tab there, you can view the archives for using the Power Options tools for radioactive trading. It's broken down by section. There's a lot of information available there for you.
Got it. Okay, Mike, I sent out a link to everybody to get a two free week trial. No credit card required, no obligations. It's www.powerop.com/RAT if you only just want to try that. But we also had some folks say, hey, I'd like to know how to get the blueprint. So I'm going to go ahead and make that information available. Are you seeing my screen okay, Mike?
Yeah, you now have a viable solution through the polls. You can plainly see the difference, starting with very little risk, bulletproofing, and even taking income afterwards while still leaving the upside open.
Okay, very good. How to get the blueprint? If you already own the blueprint, I want to emphasize the importance of using Supporter because a lot of these ideas are new. They're not hard, they're new. You know, because you may be used to the limitations of covered calls, or you may not have experience with purchasing put options to protect your stock. Some of the concepts are going to be new, and guess what? I want you to write in, either myself or Mike or Greg or one of the radioactive crew here. We've probably dealt with the question before, and we can answer it to you and your situation exactly. Okay. For tools, Power Options has the best solutions. Again, I've sent you a link. I'm going to give you an opportunity to get a month instead of free 2 weeks. So as far as the blueprint is concerned, here's the 3 parts of any offer. Okay, what you get, what it'll cost, and what you risk. What you get if you order the blueprint is 250 pages of instruction on how to limit your risk in the first place, right? And then how to leave your upside open and use as many as 10 different adjustments to reduce your risk and to capture more movement. Okay, all 10 income method adjustments. You also get 3 bonuses. The quick action guide, which will teach you how to convert your existing positions into radioactive positions. The Foundations of Radioactive Trading CD, which teaches how to allocate your assets if you're not sure how to spread them out and position yourself just right. why then that Forts CD is the answer for you.
Right.
And of course, you can get a free month of Power Options with the real-time quotes. They've got a $59 version, which is 20-minute delayed, which is actually as much as you really need for a lot of the things that we do. But they're going to give you the deluxe version, you know, the real-time, the $79 version for nothing, for free, if you pick up the blueprint. Here's what it costs: $339 plus $11 if you live in the U.S., as much as $41 if you're overseas. Okay. And let me ask you something. What if that $339 investment were a married put? Okay. The most that you could probably lose then is $339, right?
Mm-hmm.
Okay, but of course your upside is unlimited. You know, you might find that the information in the blueprint will, in fact, change your trading picture. In fact, we had 100%. I don't want to have to show the poll again, Mike, but we had 100% say that if they had only practiced what I began to show during the first half of the presentation, if they had only practiced that, 100% of our audience said in one way or another that they would be better off. 100%. Okay. All right. So if the 339, tell you what if what if it wasn't worth it? I mean, what if you took that 339 risk and you decided, man, you know what? I don't know. I don't think this really is going to help me at all. Well, send it back. Okay. Then we've taken away all the risk. It's just like a bulletproofed married put. Okay. Unlimited upside, but no risk for you. Okay, so what you risk is nothing, and what you could gain is the knowledge of how to finally begin winning at this game. Okay, we have a 100% money-back guarantee, and you can keep the bonuses, including the month of Power Options with real-time quotes. So here's the deal. Get the blueprint, the quick action guide, Foundations of Radioactive Trading CD, a month of Power Options, and if you decide to try Fission, we're going to knock $59 off of the price. Fission, of course, is the monthly subscription where you look over my shoulder and see how I'm responding to the market. Okay, your first month is $10 if you decide to do that. So it's a total of $626 value, $339 total costs. Okay. All right.
And that discount on Fission is just for the first month, of course. It's just that first month at $10 to save $59, and then after that, following the Kurtz trades, of course, it would be $69 per month.
That's right. Okay, Mike, so we've taken away all the risk, but I want you guys to remember the guy from Colorado Springs about a year ago. He said $30,000. I looked at him, and at that time I was selling the blueprint for $289. We had to raise the price, but at the time he was looking at spending about $300, and I said, well, you can buy the blueprint for yourself, and then for 99 of your closest friends. And of course he laughed, and he did buy the book, and we've been in touch since. And now his trading is in a positive. Now he's making money with his tradings. So very good. Okay, Mike, I think that's our Dog and Pony show today. I don't have anything to add unless there's some questions from our audience.
There's a question. Dan sent in a question about he's looking at ABX, and he wanted to know, would this be a good radioactive position? Well, Dan, we can't answer questions about a particular stock. We can't give direct recommendations or suggestions. We received your email before the presentation, but neither Kurt nor myself had time to answer it before the presentation started.
Mike can walk you through how you could use the search by symbol and determine which puts might be the ones that would fit the radioactive criteria.
That's right, and I believe Dan owns the blueprint as well. So yeah, the Power Options tools will help you. You just have to decide firsthand what is your expectations of the stock moving forward, what is the time frame you're looking for, that'll help you determine it, and what is your risk threshold. You know, Kurt, we saw that default screen was a risk of about 3 to 9%. My personal risk threshold is I don't go above 7%. Not because that works better. I don't have any statistical proof that that works better than what Kurt does sometimes or what Ernie does sometimes by taking an 8% risk or maybe a 9% risk. It's just my personal threshold.
Very good. Okay. All right, so we've answered questions for Dan. Folks, if you think of a question that was not handled by way of the presentation itself or by way of responding to you, send it to support@radioactivetrading.com, and we'll get back to you right away. And Mike, you sounded like you did have another question come in. That
Well, there's another one that we don't have the time to answer, of course. It was a question revolving comparing the married put position to other strategies, some of the synthetic trades or parity trades. And I believe it was Scott that sent that question. Now, Scott, what I want you to do is if you go to radioactivetrading.com and go into the blog, you can search on the blog and search for articles. Kurt has several articles on there on comparing married puts versus long calls, for example. So you can run a search for married put vs long call, and you'll see about 5 or 6, I believe, blog articles that Kurt has written that shows his thoughts. And then, of course, you have questions following that, just send us an email, and we'll take a look at it. And
Super.
Steve wanted to know about the optimal put to use. Well, Steve, that's kind of discussed in the blueprint, of course. Again, it's not so much about the optimal put to use because it's based on your expectation. You really want to focus on the percentage at risk and not be concerned with, is this the right put, is this the right put? Hey, really, if it's down to single-digit risk, comparing a 4% at risk on a strike price to a 5% risk on a strike price, one may be optimal to the other depending on what the stock does, but as long as it matches your risk threshold, that's the goal. That's where you want to be focused.
Very good. All right, Mike, thanks so much for joining me, and I'll see you again on Thursday. And I want to mention to everybody that is a Fission member, if you decide to become a Fission member before Thursday, I have a special presentation about trading the married put positions with an edge, so you can look forward to that. Okay, gang, thanks for coming. We'll see you out there. Happy trading, and bye for now. If you haven't picked up the blueprint, remember you have no risk to do so, and I'd encourage you to do it sooner than later. All right, Mike, you're the best. I'll see you in a couple of days.
All right, Kurt.
All right, gang. Bye for now.